ladies and gentlemen. Welcome to the Money Mentor podcast with your host, Graeme Holm, aka Australia's original money mentor. And again, we have the amazing Dr. Andrew Wilson. Now, again, in case this is your first time and you've been living under a rock, Dr. Andrew Wilson is Australia's leading independent property economist, and independent is the key word. His information and his advice and knowledge and data is not skewed towards any bank agenda, government agenda, any particular organisation. I say again, independent leading economist. Now, who is Doc? What has he done? He's currently the chief economist of My Housing Market, previously chief economist of Domain Group, and a whole heap of other very well-respected organisations. Qualifications-wise, why do you need to stay tuned? Well, most of you know, but if you're not aware, Dr. Andrew Wilson holds a Doctor of Philosophy in Housing Market Economics from RMIT University, Master of Science by Research, RMIT University, Graduate Diploma in Economics, Monash University, Bachelor of Construction Economics with a distinction. He's a smart cookie, RMIT University. He's also a member of the Royal Institute of Chartered Surveyors. So I'll leave it there, because if you add all those letters up when you start going PhD, MSc, grad, he's got more letters after his name than I have in my legal 3 birth names. So good morning, Doc.
Yes, g'day, Graeme. And we're sweeping through October, are we not? Already into the second week of October. And the year's just flying by, isn't it? And
it's almost Melbourne Cup.
I was going to say the next big event is Melbourne Cup Day. And once we pass Melbourne Cup Day, which is in 3 weeks' time, then the next one's Santa Claus, isn't it? And then it's next year.
We're nearly there.
Yeah, but certainly a lot of interesting news over the past week, as usual, I guess, in terms of housing market activity. And we've really been speculating, Graeme, over recent weeks, really over the past month or so, that the signs were emerging that our housing markets were starting to reach for the bottom, particularly the Melbourne and Sydney markets, which did lead the charge downwards through winter. Of course, they were the strong growing markets over the past year, 18 months, boom time conditions, remarkable prices growth. You know, we've had a hangover following that big party. No surprise, high prices start to push buyers out of the market. And of course, a lot of the COVID pent-up demand had been satisfied. And then along came the Reserve Bank, and up went interest rates, up and up and up. But the last time it didn't go up quite as high as expected, Graeme. So
yeah. What's your take on that, Doc? I mean, we've got some people out there and gurus and economists saying they waited too long. They should have put it up quicker, like the rest of the world. I'm saying, well, we survived this COVID thing pretty comfortably, I feel. So do you think they waited too long, or now they're being too aggressive? Or, I mean, the data I think we'll see again today tells us that we're doing all right compared to most of the world. So what's your thoughts on that before we jump into it today, Doc?
Yeah, I think you're right, Graeme, that it is a bit of a rerun of COVID. We certainly survived COVID in better shape than just about everyone else globally. So pat on the back for that. And, you know, it looks like we're going to survive the post-COVID inflation rise as well, better than most. Certainly our inflation rate remains well below other similar advanced economies. And our interest rates are well below other similar advanced economies. And that's a bit of a cause and effect. So that's no surprise. And one of those other cause and effects, Graeme, is the Australian dollar, which is now pushing down towards 60 cents and may even go under 60 cents. Now, that might seem like a bad news story, but it's really all about the US having a strong dollar. And the strong dollar in the US is really about the prospect that the speculation that interest rates in the US will continue to climb sharply. And that means that there's a lot of capital flowing into the US, attracted by those higher interest rates, that higher interest rate differential. And that means that currencies are weak compared to the US dollar, and we're no exception to that. But look, that's really good news for our exporters, because that means we will be able to get more bang for our buck in terms of our exports, particularly our resource exports. And we have record terms of trade at the moment, Graeme, which is the difference between imports and exports. That's because our export sector, mainly resources, has been booming. Prices are high, demand is high. Now with a lower dollar, it means that by and large, we will get even more drive from our exports, which just acts to strengthen our economy, gives us more money to spend basically. And that's a really good position for us to be in. The Reserve Bank's been hoping for a lower currency for some time now, so they'd be quite happy with that. And I don't think that we're getting the other side of the equation for that, and that is having to pay higher import prices. And that means, that we start to import inflation because it's really China's our main customer, or we're their main customer for imports. One of their main customers for imports, and they are too suffering from that high US dollar environment. So we don't really import a lot from the US in terms of consumer goods. So it's maybe another, good luck or good management type of scenario for Australia, that low dollar will work to improve our economy rather than push up inflation. But it's not all Skittles, Graeme. We've got to mention a few things this week that have changed.
Okay.
Yes. So a bit of a negative Nelly here in terms of the outlook for inflation. We've seen quite remarkably that the Saudis and Russia made a deal to reduce the production of oil significantly. And of course, that was a surprise to the US that have been sort of trying to be best friends with the Saudis, hoping to keep them on side. And I guess they felt a little bit cheated and abandoned through that deal that was made.
So they're doing a deal to restrict supply to inflate prices, obviously, Doc.
Well, that's part of the deal, of course. Let's be clear about this. It's all about the law of supply and demand. Of course, the problem, is that the European, the Eurozone and others are restricting the Russian economy through levies on exports. And of course, Russia is a big exporter of oil. So, this is just a strategy by the Russians to try to increase the price of oil in the face of a lot of those restrictions they're now facing because of the war in the Ukraine. So what that's meant, no surprise, is we've been seeing a significant decline in the price of oil. It actually fell below $80 US a barrel a week or so ago, but it's now back after that deal was done over 90 cents a barrel, Graeme. So unfortunately, we're going to see the price of petrol at the Bowser go up again as a result of those higher oil prices. And of course, as we know, that's a significant contributor to inflation. So just when things were looking pretty good going forward, this is the nature of the beast, that we are in, I guess, exposed to forces that we don't have really any control over. So we've just got to hope that, that there is a moderation in that increase in the price of oil, and that it doesn't add to our inflation or higher inflation environment. And just another factor that's been important, Graeme, I was going to discuss this at more towards the end of the show, but we'll tackle it now. And of course, we know that another driver of inflation in Australia has been high house price or high house building costs. And those high house building costs came about because of the home builder policy of the previous government last year, which was very successful, oversubscribed perhaps, and that meant, unfortunately, that all that demand couldn't be matched with supply. So we saw house building costs go through the roof. At one stage, the annual increase in house building costs, monthly house building costs, according to the My Housing Market Index, was up by nearly 25%, Graeme, which is a huge leap over a year. It had actually started to show some moderation over the past 2 or 3 months. We did see the rate of growth declining, which was good news because those house building costs were creating or contributing to higher inflation. But unfortunately, the latest August data, the latest August index, has shown a rebound in house building costs over August. Now, house building costs are up over 18% over the year to August. Now, that's not as high as the 24% peak that was recorded over April. That's annual growth in house building costs. But still, it's unfortunate because it looked as though we were starting to see the end of the over demand and under supply, I guess you'd say, of house building. But now we're still in that environment where house building costs are rising again. So hopefully we'll see an easing going forward now. Latest building approval data showed that, look, we're settling in terms of building approvals for houses and units. There was a big fall last month, over July. No surprise, house building approvals or unit building approvals rebounded strongly because they're a very volatile series. And overall, when we look at the trend for both units and houses, building approvals is settling. So it's not falling as it was, but it's still well below the levels we saw during the peak period of 2015 and 16. And a lot of that's the reason why we have an undersupply as reflected in those very low vacancy rates for units. So not all great news on the economy, Graeme, the last week in terms of our challenge with inflation. I think the Reserve Bank was starting to think, look, we don't want to belt this economy around the head. Let's take it easy. Things are looking really good so far. Yes, we have higher inflation, but we're doing better than most. And we'll wait and see what that October data, when the October data comes out for the September quarter and September for our inflation, latest inflation data. And I think the Reserve Bank's going to wait and see how that evolves. But again, it's going to be backward looking. As I mentioned, price of oil up over the last week. But I do think that the result from the Reserve Bank was a positive. I think that after 3 months of 0.5% increases, we trekked back to 0.25, and I'm not sure how anybody can dress that up as being bad news. I think that
no, I think you're right. Look, the bad news, Doc, as you said, oil is dearer. Okay, fair enough. Petrol's dearer, and due to that agreement, and the home construction costs. We've talked about this a lot over the last year, really, at all of our events and podcasts and stuff each week and each month. And, we have talked about, said, it's not going to get any cheaper, that's for sure. We've got a shortage of homes. Yes, It was escalating really out of control. It did settle for a while. You said, look, it's starting to actually subdue a little bit, but now it's just creeping in a little bit again, maybe shortage of materials again, maybe a bit more activity. So it has jumped up a little bit again, right?
Well, again, Graeme, in a way, it reflects more demand coming into the market, and
Doc, that's got to reflect consumer sentiment. People are comfortable again.
Well, we actually did start to see house building approvals have now consolidated. They look like they've reached their floor now after that big growth last year. And in the latest data has them actually increasing marginally. So again, there's a lot of work in the pipeline still from that the home builder policy of last year, and that still has to be absorbed, Graeme. But it's about the rate of growth at the end of the day, and we've seen a blip upwards that can happen. I guess it's about going forward what the data over the next few months indicates. But I do think that I think there was a struggle from some media outlets when we did get the Reserve Bank decision. It was like, oh, shock, horror. We've had another interest rate increase. This means you're going to have to pay an extra whatever dollars on your mortgage, blah, blah, blah. But I think the real story was that it shocked just about every commentator, because everybody, bar, I think, the Commonwealth Bank, was predicting a 0.5% increase. And when it came out at 0.25, I think that's, compared to 0.5%, I think that's unequivocally good news. And I do think there'd have to be, in my opinion, some quite severe data for the Reserve Bank to pop back up to a 0.5% increase next month. And next month is the go month, really, for interest rate decisions. Melbourne Cup Day will be the November decision. If the Reserve Bank's going to act in a substantial way, it will act on Melbourne Cup Day. Maybe it's done it a month before with that October shock result. But because December tends to be a negative month for interest rate movements by the Reserve Bank, because we're all in holiday mode and nothing much happens regardless of what they do with interest rates in December. And of course, they don't meet again until February. And there's not a lot of data in February to go on in terms of making a decision.
And they also, Doc, they don't typically in December want to come and absolutely crush consumer sentiment and families at Christmas time. Yeah. So they tend to sit idle most Decembers.
Yeah, and that's the point. The next decision isn't until February, so it really doesn't have much an effect because we're all on holidays. Yeah. You know, so it's a distracted scenario. But that's why November tends to be a pointy month in terms of decisions, because it's their last chance to really, if they have to do something substantial that will have an impact this year. So look out for that. But of course, the key to all of the November decision will be the inflation data that comes out in a fortnight, and that will guide them in terms of their decisions. But it would be a surprise if they went back to a 0.5% increase. Now, we mentioned the Commonwealth Bank there before, Graeme. They were the only ones that predicted a 0.5% or 0.25% increase. Everybody else was going with that 0.5%.
Jeez, I wonder how they got it right for a change.
I don't know, Graeme. I can't comment any further on that. But I will say something. As I said, it was a bit out of left field, that prediction, but they were spot on, so you can only be right. But interestingly enough, the latest from the Commonwealth Bank is that they're actually predicting only one more interest rate increase in this series. So, you know, if they get that one right, as they got the October decision right, I think we're going to be pretty happy with that. In fact, they're speculating that we will end this cycle under 3% official rates, and that's a lot lower than many have predicted. So as we have said previously, Graeme, we believe that the signs were emerging that the interest rate cycle would peak lower and earlier than many have predicted. And it's really looking that way now. So if we do get a November increase in rates, well, according to the Commonwealth Bank, it might be the last one we have, Graeme.
Well, it's probably about the only time I'll agree with any major bank in Australia. So, hey, I'll take it.
Yeah, right, mate. It's good news, but we'll see what happens. But that'd be a lovely Christmas present, wouldn't it?
Oh, absolutely. Yeah, well, as you say, every rise is one step closer to normalisation or a decrease, and
that's right.
Maybe they're right. I mean, the RBA hasn't belted it on the head, but we have belted it on the head effectively over the course of this year. You know, they've just given it enough to scare people and slow them down. Yeah, they've managed it quite well in so. We never want to be an advocate that anyone's doing anything too well, but they've just spread it out fairly evenly.
Yeah, Graeme, and I think it's horses for courses, and they're just managing our economy as they see. And I think that's good because they're not being guided by what's happening overseas, where they're in a completely different environment. They're not looking good in the UK and the US in terms of inflation. They're going to need to raise their rates and raise because their inflation has really got right into the system over there. I don't think we're in the same scenario. I think we're just still suffering from factors such as high house building costs and oil costs. So we haven't really worked our way into the higher service costs, which typically come about when wages are being bid up quickly, which we still seem to be under control with our wages growth. And it's not really affecting, signs of consumer activity. We had another record August for retail sales. They're still rising, Graeme, and they're well above where they were still pre-COVID. So people are out there still spending like drunken sailors, and that's because we have a booming economy. And I think that all reflects some more positivity in the housing market emerging because, with full employment, record low unemployment, wages are rising, people are doing okay. You can get a job if you want to get a job. People are chasing you to work for them and offering you more and more money to do that. So you want to, get on with life, and that means, getting yourself a home, a bigger home or a home somewhere else. And I think that's starting to grow. That energy is starting to grow through what is, typically the peaks, selling period of the year, which is spring. And I think we're going to see that starting to emerge. The data's already clearly showing an improvement in the market. And I think we alluded to that early, Graeme, in terms of weekend auction clearance rates.
You did. The numbers don't lie, Doc. And as you said, people are still spending like drunken sailors. People are still upgrading homes, need somewhere to live. So let's jump to some of the data set for this week that you've prepared for us, because we talk about that magical number, in the auction clearance rates, around that 70%. Yeah. Now, having a look at your data this week, we're nearly there everywhere.
Yes.
And hang on a minute. Nearly 70%, nearly, almost. Yeah. So where were we in Sydney this week?
Well, it was, for Sydney, of course, it was a return from the public holiday the week and before, Graham, Labor Day public holiday. We only had a relative handful of auctions over Labor Day long weekend. The clearance rates fell away, which was, a holiday result. You only really get the lower end of the market active during those holiday periods. Big end of town sort of takes the break. And of course, buyers and sellers are distracted. So the market came back with a vengeance on Saturday in Sydney, 631 auctions, which is quite a strong day for auctions. We always see that sort of rebound. We won't have as many auctions in Sydney this weekend. So not as many choices for buyers out there. So maybe that'll put some more upward pressure on clearance rates. But that Sydney clearance rate of 67.2%, wow. We had a 67.2 3 or 4 weekends ago, Graham, and that looked like a bit of an outlier. So we took that one with a bit of a grain of salt, but the market came back still around the mid-60s after that result. So it is the same as that result a month ago, but of course it's coming from higher rates through that period. So it's a much more realistic, I guess, result of what the market's providing. So, as you said, we're now in, I guess, reaching distance of 70%. And I think that we can use the 70% auction clearance rate as a bit of a benchmark when the market shifts from being a buyer's market to a seller's market. So that means you have more buyers than sellers rather than more sellers than buyers, which we probably still have at the moment. But it's a very even market at the moment, Graham. Around that 65% is probably generally a balance between buyers and sellers. So the next few weekends, no holiday distractions coming up, will be very instructive as to the market consolidating its improvement that we've clearly seen and discussed over the past month, Graham. And I think that was a spectacular result for Sydney, given the nature of the market and a lot of the negativity that still, I guess, infects consumers out there to some degree. But I think a few of the doomsayers might be changing their position in terms of where the Sydney market is heading. Now, we also had a strong result in Melbourne, Graham. Melbourne, of course, had a lower number of auctions, 650 versus 730 the previous weekend. Of course, the previous weekend for Melbourne was the bounce back following the AFL Grand Final. So, Melbourne also had a near 67% clearance rate, 66.7% clearance rate. And that Melbourne market's been, I believe, the great survivor during winter and into spring. It's interesting that when we look at the trends for the auction clearance rates in Melbourne and Sydney, you can see that the trend for Sydney, and that's the quarterly trend, has fallen away sharply early in winter, but come back sharply, as we've discussed over the last month or two. However, the Melbourne market didn't fall as much in that midwinter period, early winter period, and it's rising now. The trend is clearly rising, but it's been a lot more of a stable market through that period, whereas Sydney's been more volatile, and they've both ended up with those sort of 67% clearance rates. So some very good signs there, really validating what we've been saying, Graham, and really indicating that the market's just starting to reach, I guess, overall for that balance between buyers and sellers. And I guess if I don't want to sort of get too florid with my language, we are waiting with bated breath to see if we can get a 70% clearance rate this year sometimes. But I must add a qualification to this, that typically we see more listings coming into the market over the second part of the spring selling season, which tends to put downward pressure on clearance rates, and that's the seasonal effect. So we'll have to wait and see if that also impacts a reviving market that we clearly have at the moment. And if we look at the other capital cities, Graeme,
I'll tell you what, Doc, sorry to jump in, but if we see more stock flood the market in this second part of spring and we're hitting 70%, I'll tell you what, if you're a homeowner or an investor in Australia, you've got to be pretty happy. And once again, the doomsday and the clickbait, absolute dribble.
Yeah, and I think, there's a lot of chat, which is really nonsensical chat about, trying to buy at the bottom of the market, which only sort of becomes apparent after the effect. But I think we might be, sort of just about there for those that are sort of looking to do that.
You know what? If you're buying the bottom of the market, listeners, if you haven't bought, you better buy today because you probably already missed it because it might be gone tomorrow.
Well, that's right, Graeme. I mean, we never know what's coming forward, but
no.
The trends are clear. We've spoken about the early signs. Now, those early signs are consolidating. There's no doubt about that. All of the data, not just my auction data, but other auction data modelers are producing the same results going forward. It is a Melbourne and Sydney story of revival, but, that shouldn't be a surprise because they led the market down. So they're the markets that are coming back. And we've got so many drivers of our housing market, particularly migration. The latest migration data, which we've discussed, Graeme, was very strong, surprisingly strong. Now, it's March quarter data, so it's obviously looking backwards. But gee whiz, once those borders opened up, it's really, been the floodgates in terms of the number of migrants coming back in. And there's also significant reports of significant numbers of international students also coming back into Australia. So we're already in a tight rental market. Where are they going to live? That's the big question going forward.
And Doc, just finishing on those clearance rates, we jump into those migrations, but exclude Brizzy. It's never been an auction market really in Brizzy, right? But Adelaide and Canberra up in the 70s as well.
Yep. Well, Adelaide's been the clear leader of housing markets over the past 12 months, really, and it's stood up when others were falling. So it really hasn't gone anywhere, the Adelaide market, which is quite remarkable. But it is Australia's most, well, except for Perth, it's certainly Australia's most affordable auction market. And Canberra's been in a trough for the last month or two. But of course, it was very strong last year and into this year, followed a similar track to Sydney. But Canberra also rebounded with big stock numbers coming through compared to the previous holiday weekend. But there are only smaller numbers of reported auctions in Canberra. So we still have to wait and see whether that Canberra number will consolidate going forward as we get more auction numbers coming through. But certainly, it's clearly better news story for our auction markets going forward. And it's just really about the spring selling season, Graeme. I hate to use a cliche, but, it looks like just a spring selling season happening, even in doom and gloom.
So off the back of that, Doc, because we've obviously got the data here for all the listeners, as per always, and we're covering the basics again. And we've covered some negativity today, some concerns, oil, building construction costs again. We're always giving them the truth. We're not here to scare, and we're not here to pop them in a bubble of amazingness either, but we're talking the truth. I just want to touch a little bit today from an economical standpoint and all of your expertise. We talked about this a lot together over the last few years as rates were going up and people were thinking that, previously when they thought they might in the talk of it. Obviously, banks assess, for the people that haven't listened to us frequently or regularly, banks assess your capacity to repay several percentage points above your loan. So for example's sake, a loan a year or two ago at 3% per annum might have been assessed at 5.25%.
Yes.
So I just want to talk about this a little bit, Doc, because people are thinking, well, how come all this doom and gloom? The market should have popped. There should have been a bubble. People should be losing homes. But when they got this loan a couple of years ago and people said, they're borrowing too much, it's too dear, and they had to pay 3%, the bank was pretending it was 5.25%. So obviously they're doing that out of the customer or the borrower's discretionary spend or their savings, etc. And families have never saved as much in the history of Australia as we did during this COVID period for a couple of years. I just want you to talk a little bit to this point so people understand that, yes, people are just adjusting lifestyles. They maybe had a lot of savings. They're ahead of payments. They maybe don't eat out 4 times a week. It's 3 times a week. I just from an economical standpoint, can you give some insight into how this has played out with the amount of savings we've had? How have people survived? Because it was meant to be doom and gloom, but it hasn't, right? So we've got some good lending policies in practice in Australia and good regulatory policy.
Yes.
We've got a really good framework.
Well, that's right. And this is part of Australia's secret, is that we have just 4 banks and they don't have to really take risks. So they don't let us take risks.
True.
We would if we had the chance, particularly in a rising market. And that was the problem in the US. And, and we sort of over-risk manage our lending environment. But like I said, that's a good thing because it offsets, times such as when we do have higher rates or an economic shakeout, which we haven't had. But really the main focus on all this should be the data on arrears and loan defaults. And they're still at record low levels, Graeme. I mean, that's what we look at in terms of the security of our lending environment is if people are managing to, repay their loans, on time going forward. And again, a lot of that was COVID where people were actually paying down their mortgages through COVID because of all that sort of scary talk that was happening. But, our arrears are, still at very low levels. And the key to arrears, Graeme, is always, despite all the nonsense that's spoken by so-called commentators, and I even noticed the Reserve Bank was sort of buying into, that, we expect there to be some stress at the lower end of the market. Well, as long as you have a job, you'll pay off your mortgage, and that's the point. And as you said, there are various mechanisms that are designed to actually help you when interest rates do rise, such as the buffer. And the buffer obviously is working now. But we've just said that, the Commonwealth Bank is saying 1 more interest rate increase, and that's it. Maybe it'll peak at around 3%. So, that, and here we are with record low unemployment, wages are rising, and we don't have any sense of rising arrears or defaults in our mortgage market. So again, it's all the positives about the Australian system. And it's inarguable. This isn't opinion, Graeme. This is just the facts, Well,
this is a funny one, Doc, because I had some clients say, I read this and I read that. And I said, actually, I'll tell you what. A young gentleman, Josh Tesselin, youngest Ray White franchisee in Australia. He runs Ray White and Quakers Hill there in the Hills District.
Yeah.
He's the number 1 agent as far as sales in Australia. And the Hills District is, it's good, salt to the earth, mid-socio-economic area. You're talking properties just under $1 million, properties just over $1 million in Sydney. It's not the northern beaches, and everyone's pretty realistic out there, middle-class people, working class. He had 6 auctions on last Saturday. He sold 6 from 6.
Yeah.
And the worst result was $170,000 over reserve.
Wow. Gee whiz.
6 from 6 and $170,000. Now, when you're in a market where they're $850, $1 million, $171,000 is 10-20% over reserve on a lot of those properties.
Yeah.
That means that was 20% in a lot of cases over what people were happy to sell for. And you're in a mortgage belt suburb that should be defaulting according to the commentators, and they're paying $200,000 more, and the bank's approving the loan with ease.
Yeah.
I'm confused. I just scratched my head, Doc, at some of this commentary, and I think that's a really good example. As at last weekend, where's the stress that they're worried about?
Well, where's the stress if you've got a great job and your wages are rising and you've got your choice of 5 other jobs or more?
I was about to say, if you hate your job or you hate your boss, you go get another one and they'll pay you more right now.
Right. So whatever, and they'll do anything to keep you. So it's like, where's the problems here? And yet people, those that are, making these outrageous doom and gloom predictions, you say that to them and they just sort of, their eyes glaze over like you're speaking Swahili or something. It's like, come on, get real. This is a booming economy and things go well in a booming economy because of the fact that everybody's got a job and wages are rising. Now, we've got to watch inflation. inflation equals higher interest rates, which equals, increased costs for the household budgets. That's the bogey in all this. But, the Reserve Bank has not slammed on the brakes last month as it has been doing. It's just tapped the brakes. So we await with bated breath, Graeme, the results of the November decision for interest rates. And we'll be looking very, very closely and discussing, of course, the implications from the September quarter and the September monthly inflation data, which will certainly drive, I believe, the Reserve Bank. But look, as I said, the numbers just don't add up and continue to be positive rather than negative. And we've basically just come through a winter market where things were down after a very strong boom time period, big surprise. And now we're starting to reach out again. And a lot of what happened during winter was driven by, the negative headlines, as we've sort of said, that phobia, fear of being involved. Buyers and sellers thought, oh, this sounds really bad, I'm not going to do anything. And now they're sort of thinking, well, gee, what a great job I've got and I'm making this money. Why should I wait?
There's almost a little bit of FOMO kicking back in, Doc, going, I don't want to wait and miss out. I'm going all right.
You can just sort of get a whiff of FOMO, Graeme.
Yeah.
And that's what's going to, people go, oh, I'm not missing out on this while prices are lower. I'm getting that nice big place and I'm going, to get my second home up on the North Coast, whatever it may be. And once that momentum starts, we're up and running. So when we get a 70% clearance rate, Graeme, I think we'll call it then.
We'll call it then, yeah. We better wait till then we'll call it. I love it. Well, thanks as always, Doc. We'll catch up next week with some new stats.
Yeah, we're looking forward to those auction results as usual. They certainly tell the story, Graeme, don't they?
Absolutely. Thanks, Doc.
Good on you, Graeme. Thank you.
Thanks, mate. Well, there we have it, ladies and gentlemen. Brilliant and informative from Doc Wilson, as always, and sometimes not too bad myself. Hopefully you found that extremely informative. And for those of you who are tuning in regularly, don't forget to check the show notes. And if you are looking for a bit more financial education and financial literacy, and you'd love to spend 2 days with people like myself and Doc Wilson and chartered accountants, etc., I encourage you to go to money-mentor.com.au. And I'd love for you to be able to use the discount code podcast1500. That's podcast1500. And you'd be able to spend 2 days with people like Doc and myself. That's usually $2,000. It'll be just $497. So have a look at the show notes, ladies and gentlemen. Look forward to seeing you soon.